why go public as opposed to taking venture capital or private equity investment at this early stage?
Right. I don't think it's they are mutually exclusive events. A venture capitalist or a private equity player can also participate in your IPO when you're going public.
Right.
So there the benefit again would be for the venture capitalist or the private equity player is that when you participate in the IPO, you first of all are buying shares in open market.
Right.
Then when you exit, you will be selling it on the floor of the exchange.
Right.
So here you will be benefiting tax wise, first of all, as
Right.
compared to the main board listing where private equity funds and venture capitalists enter into a company. They have a holding period of 3 to 5 or 7 years maximum. So what they do is when they are exiting, it would be a fresh IPO plus an offer for sale by these venture capitalists and private equity players, or it can be only a offer for sale, which we saw in Just Dial. There was
Right.
no fresh equity which was being offered by the company. It was only an exit opportunity which was being given to these venture capitalists and private
Okay.
equity funds.
Okay.
But the drawback there is that when you are offering your shares in offer for sale, the transaction is not coming under the purview of STT since it is not happening on the exchange. So there, in that case, you will have to pay long-term capital gain tax. Even if you are
Right.
holding for more than 1 year, you still end up paying 10% long-term capital gain tax. That was a relaxation which was given in 2012 by Pranab Mukherjee when he was the finance minister. Earlier it used to be 20%. Now it has been brought down to 10%. But still 10% is a sizable amount which
Mm-hmm.
you are losing. So if you get on board on a SME exchange, first is that it is beneficial tax point of view. Second is that you have an option
Hmm.
of exiting that company in
Anytime you
that
want.
5 years, which you would not have otherwise in main board listing, because there the company is still not listed, and you know how difficult it is to offload shares of an unlisted company.
So in terms of liquidity for a private equity or venture capital investor, it's good because he can exit from the market at any point of time. Of course,
Exactly.
it's not as easy to exit in an SME uh, in an on the SME platform as compared to the main board.
No, in fact, this is easier.
This is easier.
Here, when you are on SME, there is compulsory market making for 3 years by the merchant banker itself.
Right.
So basically, it would not happen that you want to sell your shares and there is no buyer, unless and until there is a certain
Okay.
period.
Okay. Right. Right. Okay.
So, and main board listing, see, we are talking about exit for this venture capitalist and private equity players before the company gets listed, right?
Right.
So there the chance of offloading your shares on the stock exchange will not arise because you would have already exited before the company gets listed.
Yeah.
I mean, it's a simultaneous process. The company is getting listed and you are exiting.
Correct.
So that's your only point in time where you can opt for an exit.
Best case.
God forbid, if the issue fails,
Mhm.
you are back to square one.
Then you have to find other buyers, other strategic buyers who may want to buy your
It's a complete different rigmarole. In fact, I'll
right.
tell you the practical difficulty is that when you go for mainboard listing, in case of private equity, I'll just deliberate more on this for a couple of minutes because it
Okay.
will be beneficial for all the participants. Is that a private equity in a lot many cases are not just holding equity shares. They also would be holding some sort of convertible securities in forms of warrants or convertible debentures of the issuer company.
Right.
It is always held as a fallback option in case the targeted IRR is not received as per the agreement between the venture capitalist and the issuer company.
Okay.
When I say IRR is that suppose the issuer company has promised a return of 20% on a compounded annual basis, and if it is not, and the say waiting period is 5 years. So in those 5 years, if the issuer company is not able to get a CAGR of 20%, then what?
Compounded annual growth rate.
Yes. So what would happen is that the exit price 5 years down the line by an IPO would be say X. Okay.
Which
But
may
if
be less.
your, yeah, CAGR is only 10%, then automatically your exit price would become X by 2. So for the venture capitalist or the private equity fund, his profits will be literally uh, written off by 50%. Okay, because if his holding is say 10,000 shares only, then if he would have sold it at 100 rupees, he would have got a better deal. But because the company's CAGR is not up to the mark, it could offer for sale for only 50 rupees.
Right. So he has a fallback.
So he has a fallback in terms of warrants or other convertible securities,
Okay.
wherein the understanding between the company and the private equity would be that suppose your CAGR is not enough to give me so it's like the venture capitalist says that today I am investing 1 crore rupees in your company, and 5 years down the line I am seeing an exit at 5 crore rupees.
Right.
So till the time I do not get 5 crore rupees, you will have to keep issuing more shares to me such that out of the sales proceed I will get 5 crore rupees.
Right.
So out of my existing holding, when I offer it for sale in the IPO, if I get only say a valuation of 4 crore rupees, so what will happen is before you hit the market, a specific number of equity shares will be converted. I mean, warrants will be converted into equity shares and given to the venture capitalist such that he will have more shares to offer and thereby he'll get more money.
So these warrants are paid for by the investor. Do they pay for these warrants?
They do pay for these warrants.
But the conversion happens at a very
Yeah,
cheap rate because the
subsidized.
price.
Yeah.
Okay, because the price is fixed way ahead in advance. There's a conversion mechanism that's fixed to offset the
And
short.
on that conversion pricing, SEBI regulations are not applicable since at that point in time the company is still unlisted. So you
Right.
can have it converted on face value also. So coming back to where we started is that in case if you go
Hmm.
for main board listing and God forbid, your issue fails, then you would end up converting the securities also and I mean, so it's very difficult for venture capitalists and private equity funds to unravel the things. It is next to
Hmm.
impossible.
Okay,
So
okay.
things cannot go back to square one, and then you are in a deadlock where you are holding a good portion of equity in the company, and the promoter also will lose interest because his shareholding is being diluted beyond a certain limit. It becomes a very deadlock situation where none of the parties are really motivated to take the story ahead.